Hey friends, welcome to our little session here on how to flow with markets when markets are not going up. We were flowing a little bit today trying to deal with technology not doing what we were going to do. But now we're ready to rock and roll. So I hope that the next little bit that we're going to spend will be helpful and give you some insight into how we might navigate the world that we find ourselves in. So a couple things up front. If you've never heard of MeFlow, MeFlow is a platform that helps the investor generation learn how to flow with markets. And we're going to talk a little bit today about how to flow with markets, how to adapt your flow around that. And I got to do a little bit of housekeeping, just as a reminder that we are not we're not investment advisors. We are here as market education providers, and so we encourage you to take this as part of how you approach markets. And the big win for us would be that you came away with some actionable ways to look at the way that you're approaching investing, and whether that's helping you or helping others, you'll be in a good place. A little bit about me and who I am and why you should care at all, what I have to say. I've been in the industry now for more than 13 years, primarily on the futures side. So in this world, there's futures and stocks and options that kind of go between. And I spent a fair bit of time with R.J. O'Brien, which is a well-known firm in Chicago, part of establishing the Chicago Board of Trade, and have spent several years doing trading development on the future side. But as we'll talk about, markets are markets, and specifically as we're looking at potential opportunities, the playbook is the exact same. So let's jump in and dive in, shall we? So we're going to go through a couple things, and start here. One piece that for anything that I talk about today to make sense, you have to understand that behavior is the market fundamental. So as we're looking at markets and we're not really sure how to discern what they're doing, there's human behavior at the base of it. And so as we go forward, there's really kind of three options for navigating market uncertainty. So we're in an uncertain time right now. There are times that are less certain. There's always potential for catalysts out there. But let's just talk about a couple of the different ways to go about that. And I'm actually going to jump to the end and show you how I look at like what do I do in the world that we're in right now. So to do that, I'm just going to log in here real quick, and I'm going to show you. Show you the types of ideas that I'm looking at right now. So this is an idea that came from today. Chipotle, okay? And this is what we call a multi-leg option strategy. So this is leveraging 4 different products all at the same time to come up with one idea. And you may look at that and go, wow, that's way more different than when I typically think about any type of investing. Most people, when they think of investing, they think really it just buy a stock, buy here and sell here. You can do that. There's a couple things to know about that, and this even pertains to like how markets work. Is that whenever you're buying a stock, this is the P&L curve of buying a stock, or even buying a market. This is the P&L curve. It's only a 50-50 proposition. So we don't know what the too high price is, and whenever we enter, we don't know if we're at that high or at that low. This is not how you build a sustainable long-term equity curve, other than leaning on the fact that markets have a tilt towards being higher. most of the time. However, when you look at things like a multi-leg option strategy, like this Chipotle piece, you get a different P&L curve. Now, what's interesting here is, so this is the P&L at expiration, and we'll talk about expirations here in a little bit. But essentially, I can get a window of profit, and as long as the stock stays between this price and this price, I will realize a profit. And also, it has a probability. So, for example, going back to this one, this is what we call an iron butterfly. You're going to be in this trade for 2 weeks maximum, and the target profit per spread is 343. Now, that target profit is not actually what you could totally realize, and we'd have to close right at $50 at expiration to see that. However, once I put this on, there is an 80% probability that I will see 50% of the max potential profit. So I have an expectancy of where I will be, what this could do when I place this investment. And this is, very different than a perspective of, well, I'm just going to be in the market and, we're going to go and hope it's there on the end. But this is, we'll come back to this. This is kind of, where you end up if you want to be, a little more juicy about it. But let's start back at where most people are, okay, when we're talking about market uncertainty. The first one, and you've probably already seen this, is that you'll see people that will say, well, this is what you got to do is you got to stick with what works, okay? So let's talk about sticking with what works, and let's talk about why that makes a whole lot of sense and when to maybe change, okay? First, if you're in the camp of stick with what works, how do you deal with market uncertainty? Well, hold fast. You have a plan. Like, you have a plan, you've worked it out, you know that there will be periods where the market will be uncertain, and so you likely have in your head an advisor who says, well, if you are in the market for more than 10 years, you historically have been guaranteed a return. Now, how much of a return that is, that's a different story. But they're not wrong. That math actually holds. But remember, you have a plan, hold fast your plan. You have a plan, right? that would be the second one. It's like, do you have a plan? If you don't have a plan, then when you have uncertainty, it's harder to stick to something. You'll start to get nervous. No one likes to see the P&L go the other way. So if you don't have one, you got to have one. When you have a plan, you have to know how to know when your plan is not working. Why is that important? Because if you know in advance how to know when it's not working, then you know when to take action and when to do something different. And for me, when in doubt, I default to the 4 questions. Okay, so if you pause right now and you don't listen to anything else that we do and you go on with your merry way, that's great. This is the only thing I can give you that will absolutely make you a better investor today, regardless of what approach you use. Okay. And that are these 4 questions that I believe are crucial to ask and answer before entering any investment. And this is not just stock market related. This could be a home. This could be a significant other or a relationship. But here are these 4 questions. Okay. First one is, what is the opportunity? Another way to say that is, what do I believe the outcome would be if I got into this investment? I am not an advocate for open-ended investment opportunities. So whether you're buying real estate, whether you're going into business with a partner, whether you're going into a relationship with a partner, have a picture in mind of what the opportunity is. When we look in markets and we look for opportunities, I never place a trade or investment where I don't know the exit first. So we talked kind of on the institutional side of the market, we call that the first trade. The first trade is figuring out where is the destination or what's the target that you're looking for. The second trade is then determining, well, what am I willing to risk for this opportunity? So not every opportunity works. At the end of the day, we're all storytellers whenever we enter a trade. So what am I willing to risk for that opportunity? And when I set that risk, you could think of that as a stop. If you ever heard the term of like placing a stop. The place where I will abandon this chance is when it hits X price or this certain thing occurs. But I'm going to set that such that the opportunity is asymmetric to the risk. Whether that's asymmetric in terms of a probability or it's asymmetric in terms of a risk reward. So, like wherever I can, I always like to have a 3-to-1 if I'm making a directional bet, or if I have a probability, I want greater than 65% probability of success to some degree. Like these are the ways that I'm stacking probabilities of success in my favor. But again, they're not guarantees. So I have to prime my brain. So what's the opportunity? That sets it. Then what am I willing to risk for that opportunity? The next one is how would I know that I'm right? So again, whenever we place investments, we're storytellers. So how should it go? If you're someone who likes to stick with what works, how should that go? The dollar cost averaging that you're doing with your investments, in your 401k or mutual fund or whatever it is, like that should continue to see your equity curve go up and to the right. If that's the picture that you have in your head, do you have in your head a picture of, well, what if it loses 40% of its value? Like, and what if that happens within X number of years? Like, what would I do about that? How would you know that you're right? And related, how would you know that you're wrong? So what shouldn't happen as you're in this investment so that you don't have to actually even take the full stop. You don't even have to take the full risk. There should be clues early on that this is not going the way that I had expected, and I either need to get back to I need to get to the sidelines and reassess, or engage whatever my other plan was. Okay, so keep these in mind for whatever way that we approach that. So if you're in the stick with what works camp, when in doubt, use the 4 questions. If you don't have a plan, if you are like, hey, it's not working the way that I wanted to, or and specifically one of the reasons that it's not working around that is that it's not giving me the return that I'm looking for. So for example, the benchmark that all investment funds look at for investments is the S&P 500. Okay, so the S&P 500. A good way to know that someone doesn't follow markets very closely is if they reference the Dow Jones. Okay, I see that a lot in the media the last couple of days of the Dow. Nobody cares about the Dow. They just don't care about the Dow. It's the S&P 500. The S&P 500 is the benchmark. That's the 500 largest cap stocks in the United States, the strongest companies. That's the benchmark. The 20-year inflation-adjusted return of the S&P 500 is 6%. Okay? So if I'm looking at the Stick With What Works plan where I'm tracking, like my investment advisors are going to track against the S&P 500. So am I seeing 6% net of fees here? Okay? So it needs to be net of fees, because if it's not net of fees, then I start to go to do something else. But that's the benchmark. So if we look at the last couple of years, I mean, we've had S&P, multiple years of S&P with double-digit gains. So it stands to reason that we could have a year, like right now, we're negative. Okay, so you're going to have years that you give it back, but what's the track over time? Okay, so that's having that in your head. If you're Stick With What Works, think about that. That's the benchmark that everybody in the market's looking for. If that is not appealing to you and you would like to do something better, let's talk about getting wiser in your allocations. Okay, so this is the second option for market uncertainty. And that is, one, start leveraging the power of when to allocate. Okay, and what do I mean by that? Going back to this insight. So behavior is the market fundamental. Tied to that is that we live in a world that moves from option expiration to central bank movement. So kind of the number one rule that you learn in equity investing or within U.S. markets is that you don't fight the Federal Reserve. The Federal Reserve is what drives everything. You pair that with human behavior, and then you understand that we are in a world where the tail wags the dog. And what do I mean by that? That means that there are derivative products for individual stocks that actually dictate where stocks can go and when. And these are known, specifically options contracts, and they exist in varying degrees of expirations. And depending on the product or index, it gives us windows. So if we were talking about what is leading to the market going down right now. Okay, why are we going down right now? We're going down right now because we are in a period from February to March OPEX. Okay, so there's expirations of option contracts every month, but then there are quarterly expirations that occur. The first one here coming up on the 20th of March. That are bigger. And these are specific turning points in the mechanisms of markets. Also, this period then typically from February to March is very typically weaker. Why is that? Because in January, get my pencil work. In January, any of you who have retirement accounts will know that, what do you do at the beginning of the year? You fund to get the tax advantage. You fund into your 401k or IRA. Most of those are a 100% allocation, meaning that they go straight into cash or into positions as part of the fund. Wall Street knows this. And so we get prices bid up into the end of the year and the beginning of the year to take advantage of these flows that are known to be coming in. So pension funds come in, and fund and get allocations. Everybody, funds their so there are typically higher prices in December and January, lower prices in February and March after those initial flows have gone out. So if I wanted to get wiser in my allocations, I could start leveraging the power of when, knowing when to allocate. And so here are some windows of when to allocate to equities. Okay, mid to late March to late May, late September to November 1st, and then anytime the market sees a greater than 20% correction. Okay? Now, we'll send this recording out so you can get the screenshot, you can look at this, but mid to late March to late May, so where we are right now, we're in this window of weakness that's going to pass at the end of March. And then we will be in a period of more constructive flows into markets that should support prices up and towards the end of May, and then we get into some weaker periods after that. I want to buy and allocate. So I may contribute to a retirement account to get the tax advantage, but I'm not going to allocate until I'm in these windows. Okay, that's going to give me a better cost basis just right out the gate. Okay, also in terms of what I'm diversified in. Lots of people are in, I do audits sometimes of investment portfolios, and people are in, this mutual fund and that mutual fund, and we're in emerging markets and we're in this and that. Essentially, what's at play is they've got you in a whole bunch of stuff, to try to get something that's working when something else isn't. It doesn't have to be that hard. Okay, you really can simply just be in one product, the SPY, okay, which is it's an ETF, an exchange traded fund that tracks the S&P 500. It's a low fee ETF. There are a couple others of these out there, but that's tracking the benchmark. So it's allowing you to basically buy the benchmark. So you guarantee that, so you don't have to be in this one and that one. We need to reallocate, all that kind of stuff. I mean, that's a playbook that's worked for a long time. I don't know that's going to work going forward, because it works like this cross allocation across lots of these equities requires that we're in a different monetary cycle than we're in right now. The last 20 years have been a very accommodative monetary cycle. We are not in that right now. Actually, and we entered the one that we're in about 2 years ago. So we're in what's called a fiscal market. So things that worked before don't necessarily work well. So you can simplify things already being diversified by just having the SPY. So if you wanted to get just wiser and have a better shot at beating that 6%, is hold on your allocations for these periods. So that lowers your cost basis, and that allow you to ride those larger moves higher in structural scheduled periods of the year that will continue unless tax structures change or something like that. Like this human behavior, and human behavior is predictable. Okay, sometimes irrational, but it's predictable. All right, so that's you. So far you can stay put. You can get wise in your allocations. The last option is kind of going back to what I showed you here, is that you can get a new playbook. Okay, I want to look here at some charts. Specifically, we are going to look at this chart. So this is a chart. This is going back to a similar period to what I believe that we're entering right now, and that is from the late 60s through 1980. So this is 10 years. If you're familiar with a pretty famous American investor, Stan Druckenmiller, he talks about the potential for a lost decade. That's what we had in that period. So what we have is we have the blue line is the S&P. The pink line is inflation. Okay. Notice that as inflation went higher, how did the performance of the S&P go? Right. For about 10 years, while we went through these waves of inflation, the markets went sideways. So how does that impact your retirement goals if you need that to appreciate and we're going to go sideways? Now, yeah, you're putting away, you get the tax advantages of that, but are you actually seeing an equity curve that's going to be there in the time frame that you need for whenever you need that? What I want to offer is that there is a way to get around this. So, whether we are going to experience something just like this again, I don't know. I know that after a long period of zero inflation, we're now in an inflationary cycle again. So since the great financial crisis of '08, we have not had an inflationary cycle at all. We've been in deflationary. Whether we're inflationary or a term to look up is stagflation. Okay. Effectively a period of low growth. So how can you benefit in periods like this? So here's what you can do. All right. One, let's look at that SPY. Okay. So here's the SPY. This tracks the S&P 500. Okay. We can see that it's had this little pullback here. Now, what I look at, and this is tied to the market behaviors, is this chart. Now, this is the SPX, which is the same. It's the index that the SPY tracks. But down here, we've got some different inputs. Okay. This is tracking volatility. So if you've ever heard of the term the VIX, people say, well, the fear index or the VIX. Here's a way to sound smarter at parties. When we say VIX, we're talking about 30-day concern. Okay, that's what we're talking about. We're talking about that the market is concerned, like what's the market consider for 30 days? There are actually other indexes that last and that are in play other than just 30 days. And if we zoom in, we see that there's a VIX 1D and there's 9. So there's a 1D, 9D, the 1 month, which is the VIX. There's a 3 month, 6 month, and 1 year. Okay. So these are all of the, and how these prices are derived is based on where participants are putting their risk or basically buying protection. So how the VIX builds is we have investors that buy protection for their portfolios, and as the market goes lower, protection gets more expensive because the need for it is greater. Okay, so what we're seeing here in the fact that this curve has gone higher, and I won't go all, I may do one just on the VIX curve at some point, but the key fundamental behavior here is that markets fall when we're complacent, and they rally when fearful. Okay? How do you know that a market is done finding its bottom? Is when the last person to buy protection has bought protection, then we're done. Okay? How do we know that we're looking to move lower? Is when no one thinks we need protection. So this index down here looks at across all of these and says, okay, back here was a very extreme complacency reading for the S&P 500, meaning that really nobody thought that we needed protection. That's when I was selling. I sell when it's complacent, and I look to buy once the fear has subsided. Now, we're in a period here where you see the white line is higher than the other colors. What does that mean? It means that there's more fear in the next 1 to 9 days than there is a year in advance. So hedge funds and investors are paying more for protection right now than for the whole year. So if you actually wanted cheaper protection, you'd go buy something that expires in December than tomorrow because it's cheaper. Okay. Well, what will happen is that, like today, we had an inflation report, and you'll notice that the market isn't barreling lower. It's kind of holding here, and that this curve is starting to turn over. Why? Because we had an inflation report come out, and it wasn't significantly worse than anybody expected, and so no one's buying puts. So then what will happen is that the market will start to move higher. Now, to understand this fully, I am going to need to draw something for you so that you can understand how this works. Okay, and I'm going to go over this briefly. There will likely be questions, but this is the mechanics of how markets work. So let's say that I am long stock. Okay, and I'm concerned that the market's going to go lower. If I buy protection for the market, one vehicle is a put. Okay, so let's go back here and look at an actual option chain. So we're going to look at options. We're going to come back to this here in just a second. Okay, so if I look, this is the SPY, and then over here are option contracts. Now, these numbers up here represent all the expirations that are out there. You can see that there are quite a few. These strike prices, so there's puts and there's calls, and these are called strike prices. What are these contracts? Each one of these are different contracts. So this is the last price of each of these contracts, whether puts or calls. And we're trading right now at 560. So you can see that this is kind of grayed out here and this is grayed out here. So what's the difference? Is that these contracts are below that current price and these contracts are above that. We'll come back to this in a second, but these are what's called out of the money or in the money. How they behave is significant. So let's say, for example, that I thought that the S&P 500 was going to continue to go lower. So the SPY was going to go lower, and we're at 560 right now, and I think it's going to go to 545. All right, I can look up here, and I can see that on April 11th, there is a put that I could buy right now for 821. Now, option contracts, every equity option contract controls 100 shares. So that's going to be $800 to buy that. Now, that's for the 545 strike. Okay? If we go to 545, by April 11th, this contract will still have value. But if we're 1 penny above that at expiration, that the contract's worthless. So these are coupons, and people, if you've ever heard people talk about options, they're like, oh, you should stay away from options. They're doing options wrong. Sorry. But options require a whole other factor than stocks. Stocks, you just need to have the price right. Okay. Like I had a buddy the other day, he showed me the stock that he had, and he's like, oh, well, I bought the stock. It's going to go to X price. I was like, great. When did you buy it? It was like 6 years ago. and but as long as he holds it and he doesn't sell it, he can get it back, aside from the opportunity cost of that. But an option contract has a fixed window. If it doesn't work by itself within a period of time, if it doesn't work, we don't get down there, then it has no value. So these out of the money contracts, like let's think about it this way. If I pay $8 here, but let's say by April 11th, we're at $500. Okay. This will be more expensive because I actually bought that and we went even lower, but we have to be significantly lower by expiration for that to have value. Okay. So if I want the prices to go lower, I can buy a put. So I can buy a put, or I can sell a call. So when you open these instruments, you can open them by both buying or selling to start them. All right. But let's go back to our equation here. So if I'm long a stock and I want protection, then I may do a combination of buying puts plus selling calls. And why is that? Okay, so for however much money I have in long stock, if I want to be protected from prices going lower, I have to do what's called delta hedging. So delta means the rate of change or the change over time. I need to protect from that delta, and I can actually build using options. I can hedge my portfolio so that my P&L basically is zero. I can lock it so that if we go lower, the appreciation of assets from the bought puts and the sold calls offsets the loss on my long shares. And then I'm hedged. Okay, this is what hedging, when you're hedging, that's what it is. Okay, so great. So if I buy a put and the market goes lower, then the dollar goes higher. Now, if I buy a put, that means that someone sold me a put. So if someone sells a put, if the market goes lower and the dollars go up, if the market goes lower, then the dollars on the sold put go down. So selling a put is another way of saying you're buying a call. It's a long position in the market. Now, this person who sells this put is important because they are often a dealer or a market maker. And this is someone who actually doesn't care about the direction. They are here, they provide a service to provide the liquidity so that you can buy that put. So what do? They will then go and they will then hedge this put using futures. So they can sell futures at the rate, and there's some complex math on this, but at a rate that offsets those sold puts. So then if the whole market goes lower, that sold put will lose money, but the sold future will offset that. So it starts with a hedge fund or investment institution that wants to hedge their long portfolio. They buy a put, someone sells that put, but then hedges that as well. Okay, so this is why when we go low enough and no one else buys puts, then what happens is that this participant buys their futures back. That's how the market goes higher. Like this is the most significant driver of market direction. This whole exchange is the most significant driver of market direction. And how much of these futures have to be bought back depends on how many puts were bought and how close we are to expiration. Okay, so the closer we are to expiration, once we're past expiration, those contracts that needed to be hedged by the dealer are no longer there. And so the dealer often will offset that inventory. And that's what can lead us to, so for example, if we barrel into expiration at the end of the month with lots of puts, I can tell you what April will look like. Is all of those puts will be gone, and then we'll have a ramp. And we can see that by watching graphically this curve. Okay? So if I see this thing revert, meaning that there are not any more put buyers out there, I know that the market's going to lead to higher prices. So this is another element of when I will allocate and buy SPY. Okay, so I buy at these periods where we revert. Notice the correlation of the reversions to, if we go here, and given how big this one is, I mean, imagine here was a reversion. Like we haven't seen those prices. So buy and revert, buy when we're fearful, and the curve is inverted when people are paying more for risk in the next day or 9 days than they are a year out. And then once that reverts, the coast is clear. When we were in COVID, we inverted on the same date, February expiration, and we reverted in mid-April. But that was the bottom. And we had actually bottomed a little bit before that, but that was when the curve had reverted and there weren't additional puts being bought and we could rock and roll. So then once I'm acquiring then I come back here to this option chain, okay? So let's say I've got the SPY right here, and today is the 12th. Let's go out and look, 7 days, okay? So right now, there are, if I scroll down here, see there is a spot here that says delta. And there's a little number here. This is a percentage. Each one of these is a percentage. What does this mean? This means this is the probability that we will be at that price in 7 days. Okay, so right now, there's a 30% probability that we will be at 571 in 7 days. And there's a call up here that is trading right now at 372. So again, times 100, that's $372. If I have 100 shares of the SPY, I can sell one call against my shares. So for every 100 shares that I have, I can sell calls. This is called a covered call. Okay? Here's what I do. If I have three days higher, so 3 days higher, on the third day, I open the option chain and I go over here and I find the option that's 7 days out, the call option that has a 30 delta, and I sell that option. Okay, so we're at 560, that's 572, that's $12 higher from where we are right now, plus $3 of premium. So let's imagine what happens is if the market then, it's had 3 days in a row higher, if it continues and gets up to that price within 7 days, then what this call is, and what call means, is it's the option somebody buys that call that I sell, they're buying the right to call my shares away at 572. But only if we're above 572 at expiration. Okay? And that's the price that they have to call them away. So if I'm at 560 right now, I've basically banked in that if I get called away, I've got $12 of appreciation. Plus, I get to keep this premium. So instead, I make $15 on it from where I am right now. However, it's still a 30% probability. And if I've already had 3 days of higher of appreciation, the probability that I will continue to move higher in the next 7 days diminishes. So if I wait for 3 days and then sell that, if we're 1 penny below that strike price at expiration, I get to keep that full $300 per 100 shares. And I can do this every week. What does it do? What does it ultimately result in? What's the math? Is that if you look for, three, and even in bearish markets, we have periods where there's 3 days higher. Okay. And I do this. So we said the SPX, okay, has a 6% inflation adjusted return. If I employ selling calls against that based on the average premium that you can collect for those calls, I can add another 9% per year on top of that just by selling these calls. Okay. So now, if you don't have enough money to buy 100 shares of the SPY, then you just start using the timing of the year to start acquiring SPY. But if you can buy, if you have, SPY in hundreds, then you can start selling these calls. Now, if I have 500 shares, I'm not going to sell all, I'm not going to share calls against all 500 shares because I don't want all 500 called away. I may share portions of that, but then I'm just going to keep recycling these and sticking to this plan and seeing an increase. And what's the worst case? If I get called away, I get called away at the highest price plus premium, and then I'm going to wait until another one of those windows, and then I'll buy more back in and just keep going like this. One other thing of why to use the SPY is that there's something significant that changed after the great financial crisis, and that is that we as a society deputized everyone's retirement to the stock market. So there's incredible incentives whenever the stock market is struggling for the central bank to step in to ensure that it goes higher. So those periods where we see 15, 20% lower, there will be Fed action. What could we expect about what's going to happen this year is that we are moving lower to get lower interest rates. Like that is the MO, because this fall, beginning this fall, but more in 2026, 27, there's significant corporate debt that needs to be refinanced, not government debt, corporate debt that needs to be refinanced, and they do not want to refinance that at the current interest rates. So how do you get lower interest rates? Take markets lower. What's a good explanation for why Donald Trump is not talking about the stock market and even alluded that it's okay if we have a recession? Because Trump and his buddies have a whole bunch of corporate debt that they don't want to refinance at the current rates. So they'll let the market fall, knowing that the Fed will cut rates to kick save the thing. And if we fall enough, they'll cut it to zero. So that's what's coming, right? So that's aligned with that. If we get 20% or more, buy some SPY. And buying the SPY, I'm diversified. Now, at the same time, I'm pairing this with, this is kind of the longer term, but I'm being even more aggressive. So if I want even more appreciation, I can use opportunities like this. These are multi-leg option strategies that operate in 20 to 40 day windows where I know how much capital I'm looking to supply. And there are, on this platform, we have 7 different multi-leg option strategies that are out there and available, where all of them are spec'd. And in fact, they include the 4 questions in them. So for example, down here, this is the, how would I know that I'm right or wrong? For this idea right here, if I have a daily close above 53.43 or daily close below 46.57, I'm out. No questions asked. Next day, I'm out of it. But every day that I stay inside of that, I'm going to move closer and closer to my expected profit. Okay. Now, putting these positions together, you can see to build this position, it's 4 option contracts, which is pretty hard. That becomes a barrier. Multi-leg option strategies like this is how you see consistent profitability from banks and trading firms on Wall Street and out of Chicago, is because options, because they drive everything, they dictate where the market will go. Those probabilities they hold. Why? Because every option contract that's traded operates on what's called a national best bidder offer. What does that mean? It means that they're all transparent. Imagine that you went to Vegas or Monte Carlo and you could see every card that was played and what everybody had in their hands. This is the options market. So when I look at an option chain and I see the positioning there, then I know what is. It's not just like, well, that's a probability, but it's probability that actually tells the thing where it can go. And the more people that stack on those specific option contracts, the more sticky it gets because of kind of that feedback loop that we walk through. So this is a way to stack probabilities in your favor. It requires more active management, and it's challenging. Many of you have never thought of doing something like this. You may not even have a brokerage account. So how could you even get started with that? Is you can get a free account here at MeFlow, and then you can log in each day, and we'll hand select ideas like this that we'll curate them down, and then you can say, okay, yeah, I understand that. Oh, that's interesting. As far as entering the trade, we'll make it really easy. Like you can just say, okay, yeah, I want to add this one, and I'm going to open this trade, and I'm going to do, 3 of them. So that's going to require $14.73 in capital, and then the next day that P&L will update. So we run this every day. Whenever you feel like, wow, this is doing well enough for you, then you can pair a brokerage account with it, and trading it is still the same. Why do more people not do this? One, they don't understand this. They also, knowing what stock is the best candidate for which strategy it takes a decade of understanding and education and practice, and most don't do that. So it becomes a barrier. But recently, because of how commission structures have changed, these are far more cost effective than in the past. So let's look at building. I'll show you this one and just how cumbersome this can be to build. So we're going to use a UPS double diagonal, the 115, and we're looking at the April and May. Okay, so we're going to go to UPS, and we're going to go to the strategy builder. Add a new position. We're going to the 17th, and we're going to we're going to sell the 115, and we're going to sell the 115 here. And then we're going to go to May 16, and we're going to buy the 115, and we're going to buy the 115 here. Okay, so this is the full position. Notice this is what the P&L curve looks like. Now, this specific position is called when you have a stock that's just kind of trading sideways, and we're expecting that it's going to move at some point, but we don't know when. And so I'm actually expecting this thing to just kind of keep going this way for a bit. And the first pair or spread, so all 4 of these contracts become one position. Like navigating through the chains, selecting the right ones, building this, knowing which ones, that is just a barrier to entry. What MeFlow does is it just simplifies all of that. You can just say, hey, I understand what a double diagonal is, which is essentially 2 spreads combined, and how the mechanics of that thing works. Then I can just send it to the broker. I don't have to worry about trying to price this trade and make sure I got the right expirations. I mean, years and years ago, I lost $100,000 in one day because I bought the wrong expiration. So there's significant risk of entering in the wrong expiration. So having something that can take care of that works well. But this is where, like, employing these types of strategies is how you can have a really predictive equity curve, even when markets are uncertain. In that environment, you don't try to pick stocks and pick the directions, because that's a 50-50 bet. You're combining this SPY, which with this kind of wheel approach with multi-leg option strategies. You're open to leaning into shorter time frames, so like 20 to 40 day windows, which, it's going to require you pay more attention. What's the trade-off? If you stick with what works, you don't have to look very often, except, whenever you read the headlines and then you look at your 401k statements. But if you're open to get a little bit shorter than that, then you can get better performance. And you can learn how to, as Bruce Lee says, be water and flow with the market. So those are 3 options for dealing with market uncertainty. Some next steps. 1, go back, like, what do you want from your investing? When you think about your investing, what would be the answers to the 4 questions as you think about that? If you want to do the SPY stuff, you'll get emails from eFlow. We'll kind of alert you to when there are those periods of that. Make sure that you have a brokerage account. We are not a broker. You would need a brokerage account that allows you to have approval to sell covered calls. And then get a eFlow free account just to start experiencing these multi-leg strategies. This has been the toolkit of Wall Street and Chicago for decades. You used to have to go and spend $250,000 a year to have a lease a seat on the exchange. When Robinhood, the brokerage, basically called the market and said, hey, we don't need to charge commissions anymore, they gave everyone the opportunity to be like you were on the exchange, where you're not paying fees for these transactions. So when the cost to go down and enter these trades went significantly lower, the opportunity went higher. But the barrier to entry is still, how do I apply these? So eFlow makes that easier. Okay. All right, gang. Thanks. That is how to flow with markets when they're not going up. We'll get the recording out, and if you have any questions after that, feel free. We're going to keep doing these, and we'll look for you on the other side. Peace.